Well, let's put the spotlight on OMCs, and in particular, let's chat with the management of HPCL to talk about the impact of crude oil prices and the falling Singapore GRMs. Rajneesh Narang is the Director of Finance and CFO with us on the show. Thank you so much, Mr. Narang, for joining in. Given that Singapore GRMs have fallen significantly from their recent peak of $15.4 a barrel in August, what kind of an impact do you expect on refining margins?
It is expected that with the coming winters and the demand for HSD and other products picking up, the GRMs are likely to improve further. It's only going to get more firm rather than further softer.
Now, at the same time, crude prices have declined, which benefit your marketing margins. So where do you see crude price headed in the recent fall, and what kind of an impact will we see on your marketing margins, just to reiterate?
Yeah, see, the crude oil prices have softened a bit, but if you see in the near future, the prices have been quite volatile. It's not that the prices are continuously falling only. The prices are coming down, then they are again going up. Now, we don't know what would be the outcome of the OPEC Plus meeting, which is scheduled for tomorrow. Now, if there are any further cuts, then there is a possibility that the crude prices may again increase and people may start taking positions because of the supply demand scenario. So, yes, if the crude prices come down, it definitely helps us. But it also adds to the inventory losses, because to the extent of the inventories which we hold, we have to take a hit on the refining front on that front. But since we are managing on a integrated margins, that is refining and marketing, yes, it more or less it sets it off, and I hope that the current period would be a fairly good period.
Right. You know, recent brokerage notes suggest that higher marketing freedom after 2024 general elections will actually aid HPCL earn reasonable integrated margins. Would you concur with that opinion?
Yeah, we have always been operating on integrated margins. So there's nothing new which has come out in the report. And yes, if you see the past, the refining has been good. The entire past 1.5 years, and going forward also up to in the near future for next 3-4 years, the refining margins are expected to be firm. And on the marketing front, yes, the volumes are there's a growth coming out in the petroleum products. And if the prices continue to be in this range, and that is what we are expecting, that the crude prices would be range bound between $80 to $85 a barrel. And if that is so, then the performance of the oil marketing companies are likely to be.
Imports from Russia rose by 64% in April to October period. How much Russian crude is HPCL importing, and how much of discount are you getting there?
See, yes, we have been importing Russian crude, and we are taking it on TAP prices. As regards the discounts are concerned, it keeps on varies depending upon the demand supply balance. The discounts have in fact come down, and in terms of the quantum, almost 25 to 35% is what we are doing of our total imported crude diet we are importing from Russia.
So is there a strategy to unlock value for the lubricants business? Is that in the works? And what are you evaluating? Is it going to be a demerger, an IPO, a strategic partnership? Any sort of progress that's been made so far?
Yeah. What we have got the in-principle approval from our board. We are on course to take it forward, and what all the options which we have stated, all are being evaluated, and in the near future, we will definitely take concrete steps and we'll let you know about it.
Right. And given your aggressive Capex plans, what's going to be the EBITDA guidance over the medium term, say 3 to 5 years?
See, our EBITDA is likely to be more than 2x of the EBITDA as on 21-22. So that is what we have planned, and we have already started seeing the same, because once our Capex plans are getting matured, what all new additional capacities we have created, the quality of the assets have improved. All that will mature and will give us the incremental margins, and the total EBITDA is likely to grow by more than 2x. Of the 2022 levels.
Capex of about 7,500 crores over the next 5 years. Can you throw more light on the breakup plans and how will this be funded?
See, we have a plan of spending almost 75,000 crores in the next 5 years. And the capex could be in the range of 14 to 15, 16,000 every year. Out of the total capex, almost 35% would be in the gas and the renewable part, and 50% would be in the core sector. The other would be on improving efficiencies and other aspects of it. As regards to the allocation or the source of the funding, we are past our peak debt, and whatever further capex is going to happen would be happening out of our internal generation.
All right. Thank you for taking time out, sir, and joining in, giving us that viewpoint on the crude imports as well as GRMs, marketing margins, and more.